IBOR Navigating Then Transition, moderated by Nav Ronier, LIBOR Transition Leader at HSBC. Thanks.
Thank you. So, hi, everyone. I'm Nav Ronier. I'm basically looking at the IBOR transition, a very interesting topic that all of you might have heard of about. It'd be good to gauge from the audience who's heard about the spider. Anyone know about the spider? Along Came a Spider. Anybody read the book? So read the book, yeah. I'm not getting any fees or royalty for that, by the way. Yeah. But anyway, great book, and it tells you about why the why the IBOR scandal basically happened. And this is what we're basically looking to talk about today. Just very quick introduction to my background. I basically did risk and trading at JP Morgan and Commerzbank, then moved into the whole risk and regulation space after the crisis happened in 2008. Ran a big market risk change team at Credit Suisse, and now I've been doing consulting in the whole risk regulatory methodology front office space for the past couple of years now as an independent consultant. Currently advising HSBC until they sort out the IR35 laws, as you may have heard of as well. But that's for another debate, for another discussion, for another day. So it'd be great to introduce the panel, and we can basically dive into the IBOR transition.
Right, so my name is Antoine Bouvet. I currently work in research focusing on interest rates. My current job focuses on many aspects. One of them is making forecasts, coming up with trade ideas, recommendations to investors and issuers. And part of that job also is to manage the external aspect of the IBOR transition at ING. So educating clients, keeping track of the developments, meeting them, answering the questions they might have, and also publication of notes on that topic to inform various parties and what they need to do.
Phil Lloyd, NatWest Markets, pretty similar role actually. So sit in the sales function, working with our clients globally on really anything external, market structural, regulatory that changes. So Brexit, MiFID II developments, margin, and a lot of time at the moment on LIBOR.
Clive Tucker, Royal Bank of Canada. I've run the structured rates trading desk. I've previously been on trading desks at CIBC and Dresdner. And I sit on a number of the sort of internal working groups at RBC as we work through the various challenges around the IBOR program.
Thank you. So as we all know, the IBOR transition, you've probably seen those funky slides going around from all the different firms talking about the 5 major currencies. So we know it's dollar, GBP, we have Swiss and Swiss franc, euro, Japanese yen. But it's quite interesting, what I'm doing in the sessions is I'm also telling people that there are other IBORs as well. Remember, Interbank Offered Rates is all about how you discount your cash flow. LIBOR is something that's basically written into the blood of the city. We've basically been using it for the past 30 years. It's written in textbooks. I learned it in my economics, in my degree. That's how embedded it is. And this is such fundamental change that's basically required. Interest rates need to change. The way the methodology needs to change. And it's not just for those 5 currencies. We have IBORs out in Hong Kong, in Australia, New Zealand, Saudi Arabia, Middle East. You name a country, there will be an IBOR. So it's something not to be taken granted for. Before I hand over to the panel and we dive into a couple of questions, there's 2 things that basically start the whole IBOR transition off here. First of all is the principles that are set by the FSB from BCBS IOSCO and around how interest rate benchmark should be set. The second one is the EU BMR, and that's called the benchmark regulator, which basically benchmark regulation, which tells you about how an administrator, etc., setting should basically be done for the interest rate. We'd be here all day if I went through all those regs, and maybe if Brexit happened, we don't have to comply with the EU BMR. But again, that's a topic for another day. So why don't we kick off with our first question? And as we know, the regulator has. Sorry, is anyone from the regulator here, by the way? Good, so we can be very open in this conversation. Excellent. So from the regulatory perspective, what the regulators are asking in terms of the replacement for GBP, for JPY, etc., is basically looking at a backward-looking rate. And the market is basically having this issue with how do I move from using an overnight backward-looking rate which used to be a forward-looking rate before with LIBOR, to an overnight backward-looking rate. Now, it would be great to get your views from Antoine, from your perspective, and how that's going to be dealt with from moving from forward-looking to backward-looking.
Well, I'm going to start with the economics of it, and then we can move on the practicalities of it. But I'll be quite keen to hear also what the other panelists have to do. But at the very base of it, we're replacing one interest rate that is basically based on contribution to one that is based on actual transaction, and but also that is based on interbank lending versus some will be like SOFR based on repo rate, and they'll be reflecting not only interest rates, but also demand for collateral. And one of the things that, in a way, brought that IBOR transition to the surface and made it maybe more public than it was previously is a spike in repo rates in dollars, and in a way, or in a perceived way at least, the way the Fed has lost control for a very short period of time of very front-end interest rate in dollars. So it's something to grasp at the beginning of that debate, because if you're going to have exposure to interest rates, that's a broad term, and generally speaking, you're talking about the same thing. If you look at the practicalities of it, it's actually quite a different beast, and it will behave quite differently in various market configurations. So I talked about SOFR. In Europe, the Euro STR, or ESTR, that's been introduced, is gone from being a purely interbank rate, Euribor is a purely interbank rate, to ESTR, which is basically a wholesale deposit rate. That introduces some difference. We'll talk about the difference in credit spread. That also introduced a difference in the way that the EONIA, the rate that ESTR is replacing, used to be floored by the European Central Bank. Now the new rate, the Euro STR, is not floored anymore. And so you could have a case where liquidity increases in the system and that rate is slowly trending down. So is that different characteristics? You talked about whether they were actually risk-free rates or not. That's another topic. There's another challenge that comes from the fact that in dollars you have something that could arguably be called a risk-free rate, even if using the term risk-free is always a bit dangerous when risks lurk around the corner. But conceivably it can be called risk-free because it's a collateralized loan. In Europe, just to take that example, ESTR is a deposit and therefore uncollateralized. So when it comes to comparing these interest rates, we see there's a very fundamental difference. In the case of dollar, there's a bit of a cross-purpose between bank regulation and monetary policy, but also having a benchmark interest rate. And the last thing I'll say, but just to start the debate on the forward-looking versus backward-looking interest rate, is this seems to me that it's been driven by practical reasons. It's the IBORs are forward-looking interest rates. You know what interest rate you're going to pay at the beginning of the period. This is not something that is possible if you base your interest rates on overnight transactions. So you need to replace it. There's a lot of debate that has been going on. The fact that we've settled on compounded in arrears means that you'll only know close to the end of the period what your interest rate is. And that poses all sorts of practical reasons. Maybe some of you are better placed to.
So if I just came in there, Antoine, how do you think clients are going to perceive that? That you go and say to a client that, look, I lend you 10 million in 3 months' time. He or she asks you, okay, what's the rate? And you say, well, I can't tell you the rate because I have to look back 5 days, and it might be one of those numbers in there. Compared to the old methodology of LIBOR, which was forward-looking, where the rate was always set and you could basically use that. How do you think the client's going to perceive that, and what are the challenges around that?
Shall I?
Yeah, you want to take that, Clive?
So I think having a backward-looking rate, these aren't brand new. SONIA is not brand new. It's just reformed SONIA. I think the institutional market is pretty comfortable with compounding. It's when you go out into the broader corporate space where they feel that they need this term rate for the cash flow certainty for their systems. But this is where a broader sort of education step the market needs to step in, because if we create a term rate, and there's a whole conversation we can have on term rates, but if we create a term rate, you're technically creating like LIBOR 2.0, and actually the part of the market that says they need a term rate, well actually they think they need a term rate, but we're actually showing that a lot of the corporate market can deal with compounding, and there are tools out there that can help explain that, and there's a whole education strategy that banks are pushing to ensure that the RMs can have that conversation. And the term rate has gone from being it's going to be for everyone and everyone's waiting for it, and now, bless you, and now the RFR group is created a term user group, and that user group is really to have this term rate for forward business for niche parts of the market. Now, how you define a niche part of the market is debatable, but it's certainly not for everyone. So I think there's been a bit of a wake-up call from even over the last 12 months is, oh, the market needs a term rate, yes, we're going to give them a term rate, to actually, okay, only a few parts of the market can have it. And so therefore we need to collectively, in the ecosystem, encourage, explain what compounding is, how SONIA can be stable, actually it is the right rate. I mean, having a rate based in transactions feels like a better thing than this LIBOR expert judgment, something that doesn't really reflect the real market. So I think, there's always lots of problems with everything. However, if you look at the greater good, this is the right direction. Now, how quickly we get there, and the bumps are on the right way, of course there'll be bumps, but no one said it was going to be easy.
Maybe Phil, Clive, how about the SOFR rate, where they're basically, the Fed yesterday put out a paper proposing a term, and so that this is a term rate. Now that's causing a lot of confusion in the market because people think, is that forward-looking, but that's actually also involving compounding. What would your view be there? And is that the correct judgment that they are using as a regulator? And good we don't have any regulators in the audience.
So there definitely has been some miscommunication around that. So that is not what we in the market would call a term rate. It is more it is backward compounded. It is more to help market participants to sort of see and understand what the rate is, but all it actually does is takes the daily rate for the previous sort of 3 months or 6 months or 12 months, compounded up to today. So it's more for informational value and to sort of help adaptation rather than being a proper term rate, which we would define as forward-looking based off futures or based off the markets. But any proper term rate is going to be problematic because once we're into sort of official benchmarks and as we're trying to move away from anything that is, where there might be any sort of influence on, any sort of a negative influence on any time we try and benchmark off forward-looking market prices, there's always a danger that there'll be some, skullduggery going on, and that it will sort of defeat the purpose.
Yeah, and that's the big pushback, certainly from our place. Our traders, they don't want to have this term rate out there, and I think the market was pretty agreed on that. But then it's about looking at the broader ecosystem, which is why these tools, I'm going to call them, are there to help get the market to understand how compounding works and to demonstrate the stability of it. So,
would you say that the market is actually ready for moving to compounding, and what level of sophistication do you see with your clients, maybe at NatWest Markets, Phil?
I mean, it varies. I think from just a high level, institutional clients, compounding, not a problem. The more sophisticated corporate clients, they are either comfortable with it or getting comfortable with it. And let's not undervalue the fact that to get some people comfortable with it takes time, and to ensure that your staff internally are messaging correctly also takes time, so it's nothing that's quick. I think when you get into the SME market, then it's difficult. And how that difficult part of the market, whether they're going to be the ones that can have a term, is still something that we're waiting for the RFR. I know that the user group, term rate user group task force for short, tomorrow will be presenting to the RFR group in this UK market and explaining where their analysis has got to and what part of the market can use that term. And obviously you've got to then create it, and that the banks will be streaming XQ2OIS sort of Q1 next year. That will then get aggregated up for these vendors. There are 4 vendors, which is unhealthy. And of course it's market-led, so the market will coalesce around one. However, that's a year of where my client trades or uses term rate A and then goes in hindsight, term rate B was better for me. Also, it's not going to be a liquid market, so you've just bifurcated that already unliquid market, so it's just a bad place. And it's a known problem that the industry will have to wrestle through.
I think just to for the interest of audience, there are 4 term rates being proposed for the Serior market and the Ester market. The 4 providers are, the first one is Market, there's another one coming out from FTSE Russell as well, there's a third one from Refinitiv, and the last one is ICE as well. So where we go in the market is going to be very interesting, as Phil basically mentioned. I mean, before we go into the whole sort of like communication strategy as well, how do you think that, how do you think the regulator is going to view the market, saying using a forward-looking term rate as well? And do you think that's correct in some cases for your clients? Maybe Phil or Clive.
Happy to.
Yeah, you do want to go with that one?
I think the regulator's in a difficult position here because, and I'm just talking about the UK market because that's the market I'm closest to. The regulator wants this, and has been quite clear, this is market-led. It doesn't want to be a position to saying, vendor B is the winner based on a criteria. They don't want to be involved with that. So, if they're going to create this term rate, they really need to control who uses it, because you can't have, if there is a term rate there and it's relatively stable and relatively liquid, then people will use it. How do you prevent people using it to not go back to a LIBOR 2.0? Well, somebody needs to control the access, but the regulator doesn't really want to do that. Now, that's what they say now. I think this is an evolution. And so we'll probably get to a stage where you've got to meet a certain criteria to use it. I don't know, but I think they're in a difficult position because they recognise the corporate market needs a term, but they don't want to give it to them. They recognise that they want really just to have one vendor, but they can't be the picker of it. And they recognise it's got to be controlled, but they can't do that either. And this is the very weird sort of ecosystem of this LIBOR transition that we're operating within. It's not regulator driven, but it is regulator driven by the back door. So it's you tell me.
Well, something that is a bit quite helpful with that is that they don't want that term rate to be available straight away, to give a chance to the risk-free rate, which is the favorite option, to be adopted first. So in a way, the slowness of this term rate to emerge has been helpful. The other thing is that if you want the term rate to be calculated on a fairly reliable basis and something that is free of arbitrage or manipulations, you need to have a liquid underlying futures and OIS market. And this is something that needs to emerge with the risk-free rate being the basis. So there's a bit of a, one needs to be the precursor of the other. And so in a way, hopefully that avoids the situation where the term rate gathers more pace than the underlying risk-free rate.
What's interesting though about the comment about the regulator-led but not regulator-led, and to me that's kind of a lot of the heart of why the industry is struggling here, because there's a whole lot of aspects to this. There's all the old trades and then there's all the new trades. And in every one of the old trades you have contracts. And so you have party A faces party B. You have some sort of contract underlying that. Lots of those contracts never actually envisage that the benchmark would just stop. They envisage things like, okay, we need a fallback if there's one day it doesn't print for some reason, not that it stops, and I've now got a 30-year contract referencing something which is, last fixed 10 years ago. So in lots of these sort of individual contracts, there are going to be sort of winners and losers. So you pick any individual contract and you look at it and you say, well, what's the fallback? It may be the last prior LIBOR. Well, clearly, if you're fixing a 30-year trade at a rate from today, there's a winner and loser. If if you have a loan agreement, again, your 10-year loan suddenly becomes fixed, winner and loser. Credit markets blow out. Somebody's suddenly very, very, very happy. Somebody's very sad. So, what the regulator has sort of done is kind of said to the industry, right, you sort this out. Then on the other side, you've got the industry turning around and saying, well, we can't come to an agreed solution because that's collusion. If we sit here and say, this is what we're going to do, again, we as an industry are saying, well, we can expose ourselves to essentially saying, well, we're deciding who wins and who loses. So the problem then becomes one of, within the, say, derivatives market and for banks, we're probably looking at a protocol situation where some of the various industry bodies, ISDA, ARC, are looking at sort of coming up with protocols to say, well, this is how we will transition old trades. But everything has to be voluntary. So all they can do is come up with a mechanism, say, we think this is a sensible method, but then everybody who signs up has to do it in a voluntary basis. And then So you can end up in a situation where a portion of the market will say, okay, we're good with that, we'll do that. Another portion of the market says, actually, I don't want to. I'm not signing it. And then you're into this bilateral back and forth where literally every contract has to be renegotiated bilaterally. And so this is one of the big challenges. The other area where the industry bodies are probably having more headway is more on the future-looking state. So it's easier for them to turn around and say, going forward, this is what we want the contracts to look like. This is, we will design them. We will say this is how they're going to work, and we will put in place fallbacks for all the future stuff. And that's kind of slightly the easier part. The really difficult part is the backward-looking bit, and we're not really getting much help on that, which is making things very challenging.
So, given your comments around ISDA, and we know ISDA launched a numerous number of consultations on how the derivatives market will basically work. We also have LMA as well, who have proposed how that methodology will work around forward-looking and versus backward-looking for a loan, including bilateral and syndicated lending as well. That's in consultation. Given all of that chatter that's basically happening, how do you manage that internally, given those challenges where we don't know where the rates are going to go? So, for example, we had the spike in SOFR recently due to the lack of liquidity. Fed had to come in and inject cash into the market. How do you see, from your perspective, from RBC perspective, managing the conduct risk around there as well?
Well, that's where it's difficult because my best guess is that the banks will end up signing up to the protocols because it's just easier. However, there's still whether those protocols will cover every product or just some products. Say in terms of issuance, how do you, if you've got a benchmark outstanding, how do you even reach out to all the holders and sort of explain how you're going to substitute one rate for another? You can do that through a public tender. There's other ways you can sort of look to buy back these loans. There really isn't an easy answer to it. It really is, you have to identify. I think what will end up happening is the protocols will come out, people will sign them, then everyone else will look at all their other risk buckets, and they will start having to contact individual counterparties on an individual basis, and actually talk to them about their individual trades. And that's sort of the derivatives market. Then you've got the loans market, which is a very, very different market, where I think in many cases you will see loans and FRNs and bonds defaulting back to the last available IBOR, which will mean they will essentially be fixed, because I'm not sure there'll be a way of converting them.
So I think a good example out there was a recent issue by ABP, Associated British Ports, and that was basically was a floater. It was alternatively linked to LIBOR, now it's basically been switched over to Serior as well. That was basically done with the consent of the bondholders as well. Obviously, we're still not there in terms of what the mechanism should be, but again, the regulator is going to be asking, how are you covering yourself? How are you communicating that? So, how are you doing that at NatWest Markets, Phil, in terms of making sure the clients know what they're signing up for? Do they understand what Serior, SOFR, ESTA, Saron, Taron, etc. is?
Yeah, I mean, conduct risk is sort of the buzzword right now, especially off the back of the DSCO letter, and I have a queue outside of our office of consultants wanting to give me that magic bullet of reducing conduct risk, so thank you very much for that queue. I mean, look, when you look at other regulatory programs, be it MiFID II, Margin, Dodd-Frank, it is only this sort of LIBOR transition on a global basis that has something called the Communications and Outreach Group, which sounds pretty soft when you compare it with sort of analytical charts and fallback methods and triggers and fallbacks. And so, but actually the point of this is the biggest issue, the biggest driver underlying conduct risk is around information asymmetry. And so, it'd be unwise to sit here and say there is zero conduct risk. But the more you tell people and be transparent, internally and externally, of where we're going and where we as an industry are going, what are the difficult decisions we're making, including there's no point in me saying to corporate, yeah, you're going to get that term rate when I truly believe they won't. So you have to be honest with them. And the more that you can bring them on with the journey, the better. And that's why in Europe, in the US, and in UK markets, there are comms and outreach. Now, what are they communicating? Who are they doing it to? Well, I think there's sort of three phases in my mind. There's the it's real, it's happening, stage one. And that message has happened in the LDI market a while ago. It's continuing to happen in the corporate market. So by different client types and product types, that's happening. And then the phase 2 is, well, let's talk about the thematic. It's something that we in NatWest Markets and no doubt other banks are trying to do, is let's talk about things that are really topical right now. Because if you Google IBOR transition, there's going to be so much information out there, you're just going to be like, I don't know. So you need to find somebody or a trusted bank or whoever that you think, okay, I feel that they're going to let me know. So when is the ISDA consultation coming out? What is the look-back period? What does that mean for the basis market? Is there going to be a term rate? And those sort of thematics, hot topics, communication strategy is really important. And then you get to phase 3, which I think sort of the industry is going to go into now, which is much more data-driven, exposure-driven conversations. So, okay, you're a pension or insurance client of ours, V, you're a corporate client of ours, this is your exposure, this is your cash and how you're hedging it. Because yes, we can talk about protocols, but that's only a derivative market, right? So I've got a cash market that's hedging a derivative market. They kind of want the two to connect. So long story short, I think the more you communicate with clients, the better. The more you demonstrate that you've had that conversation, the more that you can almost demonstrate you've logged that conversation, the better. Obviously, there's going to be a natural friction inside your firm between legal compliance and the business. Legal would like you to disclose everything, but from a business perspective, you've got to manage your relationships with your clients. So there's a lot of and the whole work about fallbacks is the more you talk to them, the better.
Of course. And I mean, you touched on some really good points there as well, Phil, hedging and financing. I mean, Antoine, do you envisage a situation where we basically see one leg of a trade basically done in LIBOR, let's say the hedging, because a big corporate treasurer has been doing it all their life, for like say 30 years, and issuance done out in, say, SONIA, for example? How would you look to manage that basis as the transition basically happens as well?
It's difficult, and that's one of the topics we've been focusing on. There is a basis market in most currencies, and that's the tool that should be, in theory, used to bridge that gap. Now, it depends on the sophistication of the counterparties. For most market counterparties, it's okay. For some corporates, it's not necessarily a trivial step to take. There's that issue. There's the fact also that the OIS, so the swap market with the new risk-free rates as an underlying, is slowly taking off. It's probably been one of the bright spots of that transition, probably because it involves more, sophisticated counterparties. Nevertheless, when you look at the breakdown of volumes and the maturity in particular, you realize that it's actually concentrated on a very short
end of the curve.
End of the curve, exactly. Yeah. And that poses a problem because some type of exposures are still difficult to hedge with long maturities. The other tool that can be used, and again, the problem is its use is fairly limited for certain type of counterparties, is futures. You have futures that are part of that ecosystem of tools to hedge, and that could be that are increasingly used, but they are very far from having replaced the LIBOR-based futures. So the transition is progressing. There's reasons to be optimistic. Is this a practical step to use for a lot of market participants and for a lot of counterparties to loans in particular? The reality is not really the case. What I suspect will happen is that a lot of trades will just be closed and reopened with something else, rather than having to manage another layer of derivative overlay on top of the existing risk.
Thanks. And from a revenue perspective as well, can we use LIBOR transition as and the great thing is we don't have a regulator in the room, but do we see that as an opportunity to arbitrage between LIBOR and SONIA, use the basis swaps, take a view on where the basis swaps are going?
From the point of view of a trading desk, I would say it's part and parcel of the development of a basis swap market, and basically if arbitrage opportunities happen between the future market and the basis market, by any means, this is what makes a market from the point of view of counterparties such as corporates or to loans and everything like that. No, obviously it's...
Sure. So as we all know, the transition is going to progress, and what the PRA and FCA said that towards the end of 2021 is that we will not compel banks to make submission. We don't want a panel submission, but the word is compel. So when we talk about compel, that means LIBOR might still exist. do we see, and this is an open question to all three of you, do we see a situation, and this is I think how Accenture describe it, LIBOR-geddon, you know? Do we see LIBOR-geddon happening in Q4 or Q3 of 2021, where everyone's rushing to move over to, say, Serior, SOFR, etc., and we have distortion in the market, huge risks being built up in the market?
My personal view is that people are underestimating the determination of the regulators to make this change happen. That's my personal view. I think everything that I see and everything that I hear, they want this to happen. There obviously has been talk about maybe having, a situation where you could have LIBOR continue as some sort of, fixed spread to OIS for a number of years. There is a chance that might happen at the end, but I think that is the only thing that might happen. I think the chance of LIBOR being quoted by the banks into the future is low. And you can see that even now. There's a lot more pressure. We're seeing a lot more pressure being put on managers under like the senior manager regime and so on to actually sort of reduce the amount of LIBOR product being produced, which is really difficult because obviously, as we've discussed, the market hasn't yet transitioned, so there isn't really an alternative. But so my own personal view is people are putting too much faith that it will be paused.
Yeah, I mean, I totally agree with that comment. I think the key is, how do you think LIBOR is going to end? A lot of people talk about 2021, but to your very good point, is that's when the compelling. But think about how this plays out. You've got 16 submitting banks. So you've got the ones that are undergoing the greater scrutiny, big sterling houses in the UK market. And so, we go from 16 to, let's say, 11, right? So LIBOR technically is still around. The reduced submission policy doesn't kick in yet. And so if you leave it at that, you could be sitting at a place of 11, 10, 9 submitting for quite a while. And if you think about how LIBOR is calculated, actually LIBOR becomes a pretty dark place, right? A pretty volatile rate. And so this is why then the regulators have come up with this pre-cessation trigger. And I know we're conscious of time, but it's a really important point because the market is split three ways between pre-cessation triggers. So this is really the regulator saying, we hold the right to say it's non-representative and that will lead to the end. Now, obviously, there's a debate about the announcement date and the end date and how that has the look-back period from the derivative market. But really what that does is technically accelerate the end of LIBOR. And while that sounds a very good thing, it also, the vehicle in which they're looking to do this is really driven by the derivative market, which then you've got, say, a corporate client or the cash market saying, well, hang on, I've now got my derivative market sorted, but what about my cash products, which is very unhelpful. And if we don't have a pre-cessation, then you've got the CCPs going, well, actually, I've got a duty of care to my members, I'm just going to pull the plug anyway, and then I've got a clearly bilateral market split. So how LIBOR ends, what is the car crash to trigger the seatbelt, which is the fallback, is an unknown. And until we get clarity on that point, I think we're still going to sit in this. A lot of the market is just not going to want to move, to your point, and that is conflicted with the pressure of the banks. And so you need all market participants to work together, which then goes back to why communication around these points is so key.
So that's why we know the industry is basically implementing fallbacks in the contracts and seeing what we can fall back to as well. And there's a number of vendors in this space, basically using AI, etc. I'm not sure if there's a new opportunity for Quantifi as well. Secondly, as well, lawyers as well. Any lawyers in the audience? Good, yeah. They're making a lot of money out of this as well. I'm sure you've probably been seeing this, Phil and Clive as well. How are you dealing with fallbacks, and what's just your overall strategy in terms of taking that through the LIBOR transition?
Well, so under the EU benchmark regulation, the fallback language and documentation is not fit for purpose, as point one, but also even the fallback language is not there for the complete cessation of LIBOR, so that needs to change. So what is the rate? I mean, ideally, we don't use fallbacks because you can transition away now. If there's a liquid market, a derivative market in SONIA there is, other markets less so, and there's a strategy around that. So really to encourage people, and this is why the regulators have got the tone of panic. I mean, Megan Butler, February this year, which was saying, don't wait, LIBOR's going to be chaotic. That sort of sense of panic is trying to convince people to move now, and obviously the pressure on banks.
So you mean a LIBOR-geddon, right?
Yeah, I mean, just if you can move to LIBOR, if you move off LIBOR now for new business, do it. If you can just position your back book, depending on what the market value is, then you should do it. If you don't, then you default back to this whatever's in the contract, which is the fallbacks, which is then still in debate in the derivative market. It will be SONIA plus X. X is either a 5 or 10-year mean or median look-back period, and the basis market is running around that. For the cash market, it's obviously still a big debate about how you can solve that. But yeah, so how are we dealing with fallbacks? I guess we're encouraging sign up to protocols as and when they're there, and I guess we'll see how it plays out and what the market.
But let me just challenge you there as well. In the euro market and the US dollar market, we still have resi mortgages still issued in using US dollar LIBOR, using Euribor as well. There's no timeline for Euribor remediation, as we know. We're also hearing that a number of participants who submit on US dollar LIBOR want to keep that alive even after 2021 into 2022. We're hearing Euribor is 2025 remediation target date. How do we deal with those challenges, though, as well? Because it doesn't sound very joined up, does it, right, from a regulatory perspective? Clive, maybe you want to take that one.
Well,
No.
as I said, as we already said, it's not. As I said, the regulator has kind of set the goal. They've said what they want the outcome to be. They haven't set the path. And the industry is trying to find a way down the path. And there's probably many different paths. I think they all converge in one place ultimately, but that's the challenge.
And all markets are different, right?
Yeah,
the
absolutely.
FCA's view as well, actually, SONIA is liquid, it's reformed. My market in the UK isn't as, the retail market, the mortgage market isn't as geared towards LIBOR as, say, the Spanish market with Euribor as per the US market. So actually, the UK, to be fair to them, the regulators just getting on with what they can, and they're in a healthier situation. There will be bumps than other markets, and the fact that Europe is keeping Euribor, well, you could argue that kind of makes sense, and we'll deal with it at another point.
And the other thing to remember is with dollar LIBOR, because people talk about that, it's up to the FCA. It's a London rate.
Yeah.
It's not up to actually the US regulators or the US banks to decide what would happen to it. It's ultimately under the purview of the FCA, like all the others. So I'm not sure that will.
And how about the recent developments that we had? There was a spike in SOFR as well. I mean, Antoine, would you like to go down to New Jersey and go to a trailer trash park and explain that your mortgage is going to be replaced with US dollar LIBOR with SOFR? How do you think consumers are going to take that? When they're seeing injection of, etc. That obviously depending on how much the consumer understands about SOFR, right?
I'm looking forward to that trip to New Jersey. But one of the arguments that have been put forward is that as long as any jump in that rate is contained to a couple of days, it would get averaged out in the 3 months that the compounding is calculated. Now it's true. It still has shed a lot of unwanted maybe attention to the new SOFR. One of the problems is one of setup, and it's a bit outside of the debate on IBOR. It's more on the monetary policy setup in the US, and unfortunately you can't separate the two, and so that forces the Fed to step in and to be very reactive, and also to maybe overcompensate to avoid that sort of episodes in the future. One of the things that I found amusing, but maybe it's a bit of a silver lining, is that because of that attention and the fact that that basis between SOFR and Fed Fund blew out, it actually brought a lot of volume on the futures market. And so, it was, in a way, or at least you can look at it this way, a step towards achieving the necessary critical mass for that market.
I think the other interesting thing about that, when you talk about like suitability for different markets and mortgage market and so on, is if you look at, say, the lending market in the US, there's a real problem there because ultimately they want some sort of dynamic credit spread. When you loan money to somebody, what do you want? Well, you get, an index plus a spread. When credit markets blow out, you want to receive more to compensate you for the increased credit risk. And actually, if you look at something like SOFR or SONIA, given sort of central bank actions, you would expect they would go the opposite direction in a crisis. Central bank comes in, floods the system with money, those rates go down. So actually when you're sitting there and your credit spreads are widening, you're actually getting less reward for that money you've put out. So that's a market where really there's a bit of a backlash about the suitability of these rates at all. What they really need is some sort of overnight rate plus a dynamic credit spread. But then what do you use for the credit spread piece? So you can look at something like, say, the ICE Bank Yield Index. Okay, you could use that. That should go wider in a credit crisis. But then again, is that open to manipulation? What do you do with that? How do you make that sort of benchmark compliant?
Exactly.
And then you sort of throw in things like, well, now if you've got a loan linked to something like SOFR plus the bank yield index, and now you want to hedge a product on that. Now you're into like a credit rates hybrid. just to simply hedge, a fairly basic, a floored swap, which is linked to SOFR plus a bank yield index, is suddenly a hybrid credit product. And those sort of, and so there's a whole other raft of sort of things where I think there's a lot more going on.
It's probably not an unhealthy place to be, though, because to separate the pure interest rate component and the credit, there's the question of how do you come up with that spread calculation and what products you base it on. There's also the representativity of that interest rate for the financing of banks, because ultimately the way we banks use LIBOR and interest rate swaps as a way of hedging our funding cost. And is LIBOR more representative of a bank's lending cost versus SOFR or Esther? You could argue no, it's actually a step in the right direction.
So I'm sure there's a lot of questions, and apologies if we've offended anybody from America, an accountant, lawyer, or regulator. But we're more than happy to take questions as well, just in the interest of time.
Hi there, I'm Sid Jandu. Do you have a view on, there's other large regulatory programs going on as well, like FRTB, so is there touch points that you're using one off the other, particularly around the transition period, around jurisdictional variance and getting clarity on those kind of things? New product development might be another area.
I think it makes it more complicated because so many of these sort of stress frameworks and FRTB and frameworks like that obviously rely on historical data and stress testing and all of those things, and none of this exists. So we're sort of going to be heading into an area where we've got all this new product referencing all these new indices, and we won't have any data. And we'll be moving into an FRTB world where we need to have that data. So I'm not sure they're linked, but I think the first one makes the second one much harder.
I mean, if I just come in there, Clive, I think it's a great opportunity for you to synergize your project portfolio as well and understand what are the dependencies as well. And we all know it's always a rush for budget, and there's a lack of budget. Sharing your budget between, say, IBOR and FRTB is a great way, especially with the data challenges that Clive basically mentions as well.
A related question. Obviously, the FRTB capital requirements calculation is a little bit further down the line now. Sorry. So I'm asking about the capital requirements calculation, which is coming much further down the line. But the impact on capital requirements under the current regime, how concerned are you about that, and is there any remedy?
It shouldn't make a massive change, although there is talk that capital requirements might be used as a stick to move the market over. So as in terms of this transition, they may actually increase capital requirements on LIBOR-based transactions to essentially make people move over. I can certainly see that happening as a...
Yeah, I mean, I think the regulators have got probably stuff in the drawer that they may bring out at a later date, depending on how things are going, and that's one of them. I think there is just at a broader regulatory. There have been three sub-regulatory groups, certainly in the UK market. So insurance market, fixed Solvency II. From a conduct perspective, if I move over my back book, do I get to trigger clearing margin regulations, transparency under MiFID II? And then also from a prudential, so ISDA are asked to help write a letter around FRTB capital charges and modelability. Yeah. So I think they're recognised things that need to be unblocked, and that is also something that the whole ecosystem again needs to look at, is what are the things that stop you moving? Now that it's important to not make it as a bit of a moan, or we don't like FRTB for this reason, but it's what is preventing you from moving. And can we address it? So,
I think Antoine also mentioned this earlier, that there will be the additional basis swaps in the transition period. So the overall notional volume is higher then, and I don't know if that's kind of a concern as well in the context.
I think that's where the banks need to basically do modelling and look at, you need to basically model those scenarios, and that's where we need to get more clarity on what type of rates are we using. And then using tools such as, your model risk, looking at your inventory and how the inventory is going to change, how that's going to change the top-level capital numbers, and obviously FRTB is one part of it.
Yeah, I just want to ask this question from the accounting perspective. Do we have any visibility as to what the future accounting rule will be as applicable to this FRF, and then particularly in the newly introduced IFRS 9 sort of?
Well, I think in the States, I think it was a few weeks ago, the Treasury Department and IRS in the States, for example, announced sort of a no-action relief on sort of essentially providing tax relief that would trigger if you trigger over your products, and we're going to need to see that on a more broad basis. So, you know, for example, if you've got a note and you maybe, you know, retire it and buy a replacement one, clearly that might trigger a tax treatment. So the US has sort of indicated there will be tax relief on those things. It has not been indicated elsewhere. But again, to aid the transition, I would expect the authorities would allow people to treat something, you know, before the same after, without being sort of hit by increased sort of margining and tax and so on. But so I think that'll come, but not yet.
What about loss relief in case we're an organization actually incur loss during the course of our transition?
Oh yeah, not my area of expertise.
Do we have any accountants on the panel?
I thought that was one for you, wasn't it?
About myself as an accountant, yeah. No, I wouldn't want to redeem myself, yeah. Any other questions?
Yeah, I just want to ask about the cross-currency markets, the cross-currency basis swaps. How is all this going to affect that, especially given the cost of collateral, CSA discounting?
Well, most of those, so yeah, that's an enormous operational challenge. So essentially, we're going to have to renegotiate all our CSAs. So eventually, initially, they will, you know, EONI is the first one, so obviously EONI will no longer exist in, is it next year? 2021. So,
and that's the only thing that's guaranteed, by the way.
Guaranteed. So EONI won't exist, so that has to switch to Esther. So you're going to have a massive CSA renegotiation. The trigger for a lot of that will be next year when the clearinghouses change their discounting. So they're going to change the PAI, the discounting at the clearinghouse, and that will trigger a lot of these discounting changes. I think there's going to be massive CSA renegotiation. Eventually, yes, eventually for now, you know, probably if you've got a Fed funds CSA, it'll stay as Fed funds. Eventually it'll probably move to SOFR. And for cross-currency obviously isn't cleared yet, or at least I think they cleared the first one last week. So they will switch. They will be, you'll have SOFR versus SONIA and so on a cross-currency basis, but because they're not cleared, they will end up in the sort of bilateral and or protocol world where they will have to be renegotiated as part of those.
But what about during the transition, you know, when, say, dollar LIBOR has gone to SOFR, but Euribor has not gone to Esther yet?
It will be Euribor versus SOFR.
So you'll have to have double transition.
Yeah, well, I mean, for now, there's no Euribor at this stage is not going away. I mean, there's talk about it in the future, but it's not due to go away at this point. So,
sorry, Antoine, you want to?
No, I was going to highlight this. The fact that the trigger event might not be the same on each leg, and therefore, you know, you face a double.
Yeah, the problem statement is well understood. There is a cross-currency working group. I'm not on it. But I think they're just trying to work out, well, what's the magnitude of the problem, noting all the different time frames. But it's just a known problem that the market will have to work through. I don't think there's a sort of one answer to say how it's going to happen there.
Thank you.
If I may ask another question. Obviously, we've touched on the sophistication of clients, especially in the corporate and SME market. What about the systems readiness? I think that's probably as big a challenge, if not bigger, in particular lending systems and treasury, corporate treasury platforms. Any thoughts on that?
Well, I mean, so yes, there are problems. I mean, there is an infrastructure group within the RFR. That is trying to create a log of all these problems. I mean, for example, you know, the clearinghouses don't clear all the products, so we have small parts of the market that want to clear but can't clear. So I think it's really just creating a log and working through them. I mean, the lending systems vendors, if that's the right way, and LoanIQ, they're going to be at the RFR tomorrow talking about this. I mean, and the only reason NatWest was able to come out with its loan was because we did a lot of our stuff in-house, and so we were able to accelerate what the market's waiting for LoanIQ to do. So that was a good decision. So yeah, I mean, there's a shopping list of things that need to get fixed. Yes. Like when Esther went live, you know, what's TradeWeb doing, what's Bloomberg doing, when's LCH, what they doing, CME is at different time frames. And I think the key is to trying to create that log, to understand what's going on, what's your dependencies, and then if you can to reach out to your clients on, okay, you are dependent on LCH clearing that bullet swap. okay, that's going to happen on that date. So at least now I understand why we've not transitioned that client, because it's an industry thing. But if I haven't transitioned a client and I haven't really got a good reason, that's probably going to be a bad place in the next coming quarters.
Yeah, but it's not just the operations side, it's also even the modelling side. So on the options side, we have to rewrite all our models. They all have to be rewritten to accommodate average rates. All of our booking infrastructure needs to be changed because we're going to have compounded rates built in. So yeah, it's a massive problem.
Thanks. Join me in thanking the panelists for a great panel, very interesting discussion.